What if I told you there's an EV company smashing sales records, but also bleeding cash like a busted radiator? Sounds like a contradiction, right? But welcome to the strange and electrifying world of NIO. NIO just hit record high deliveries, nearly 16,000 vehicles in a single month, yet their financial losses are growing. How does a company do everything right on the surface and still spiral into deeper debt? You're here because you want to make smart financial moves. Understand this story, and you'll learn how to spot opportunity and risk in a world full of shiny, fast-talking companies. Let's break it down. No fluff, just facts, strategy, and insight with a little suspense. Every legend has an origin story. NIO's. It starts in 2014 with big dreams, bold promises, and a name that means blue sky coming. Backed by Chinese government incentives and flush with venture capital, NIO burst onto the scene as the Tesla of China. Their sleek designs, battery swapping tech, and digital-first approach attracted millions in funding and attention. By 2021, they were a darling of Wall Street. Stocks surged, investors were hyped, the media obsessed. This isn't just a car company, analysts whispered. This is a lifestyle brand, a revolution. And in 2023 and 2024, NIO proved it with record-breaking vehicle deliveries month after month. But then, why does this feel like deja vu? High sales, rising hype, and yet the financials look like a horror movie. If I sell 10,000 sandwiches and lose $1 on each, how many do I have to sell to go broke faster? That's not a riddle. That's NIO's current business model. This is where the story twists, where the underdog faces the brutal truth of the real world. Despite selling tens of thousands of vehicles, NIO's net loss in Q1 2024, over $700 million. Here's why. Slim margins. EVs are expensive to make. Battery tech, R&D, and chip shortages don't help. Price wars. Competing with Tesla, BYD, and newcomers forces NIO to slash prices to stay relevant. Expansion pains. Entering Europe isn't cheap. Marketing, logistics, compliance, costs balloon. Revenues rising. Losses are rising faster. It's like running uphill with a leaking fuel tank. And here's the kicker. While NIO's vehicles are premium, many customers are price sensitive. That's a dangerous mismatch. But NIO's leadership is doubling down, betting on battery as a service, BaaS, autonomous driving tech, in-house chip development. Innovative, yes. Profitable, not yet. So is this just growing pains? Or is NIO speeding toward a cliff, foot on the accelerator, eyes on the sky? Hold that thought. Let's step back. What does this mean if you're an investor or just someone planning for a wealthy future? Here's the cold truth. Sales alone don't equal success. Profitability, scalability, and timing do. NIO's story is a masterclass in risk versus reward. Optimists see a future Tesla. Realists see a cash-burning company in a hyper-competitive market. So what do? Watch operating margins like a hawk. If they improve, there's hope. Track NIO's European expansion. If it clicks, revenue could spike. Monitor regulatory risks, especially US-China tensions. They're real, and they matter. Wealth isn't just built by picking winners. It's built by understanding cycles, knowing when a company's growth is sustainable and when it's just noise. Because hype fades. Fundamentals don't. NIO may rise or it may fall, but one thing's for sure. Your financial future depends on asking better questions, not chasing headlines. If this deep dive helped you see through the fog, check out my next video. Will ConocoPhillips become oil's next big thing? It's a must-watch if you want to balance your portfolio with energy plays that actually print profit. Tap the end screen right now and keep building your wealth. one smart move at a time. This is the game. Learn it, master it, win it,